All right, Casey, I want to talk to you about something that comes up a lot in the comment section on all my real estate videos. The real estate market in Canada is really frothy. It's going to crash. You're going to lose everything. So what are your thoughts in general on, say, a general Canadian real estate market crash? And like, can you sleep at night?
I thought about this quite often, crash or downturn in the market, correction. My bungalow went down from 1.9 million to 1.2 million. A real estate crash, okay? It's not gonna happen in the multifamily space. When you ever have a crash in real estate, or let's say the stock market had a crash or anything like that, my rents went up. If my rents go up, the price of the building is tied into the net operating income, the NOI, the value of the building just went up.
Are Canadian real estate prices too high? Is the market about to crash? Well, in today's video with Casey Wong, we're going to discuss both my and his opinions when it comes to the Canadian real estate market, whether you guys need to be panicking or whether you should be buying more real estate. We're going to share our opinions and discuss, is there any risk in the Canadian real estate market? Let's dive into it. All right, Casey, I want to talk to you about something that comes up a lot in the comment section on all my real estate videos. And maybe just even for perspective, I started investing in 2010, and I can remember in 2010 people told me the real estate market in Canada is really frothy, it's going to crash, you're going to lose everything. And that seems to be a very common narrative today as well. We're actually shooting this video in your office in Toronto. It's seen the highest prices kind of in market history right now in Toronto. So what are your thoughts in general on, say, a general Canadian real estate market crash, and like, can you sleep at night?
Yeah, definitely. You know, it has, I thought about this quite often, crash or downturn in the market, correction, but that's the reason why I went into multifamily, okay? We actually had the tightening the stress test, okay? And that actually, to be honest with you, it actually hurt me in my, my ride-out building, okay? So I couldn't sell it. Now all my money is trapped in there. It's not, we do have, it's comfortable, the money is there. We know that we bought it at a low value, so each building is, each unit is about 270,000, but selling about 350. You have 8 units left. Now, crash, it's gonna be different cycles or different markets, okay? So crash, what does that mean? A real estate crash is usually gonna be your single family homes, your condos, okay? There's nothing wrong with that, okay? That market, is in Toronto. What I'm saying is in Toronto. It's still fairly solid, but if there is a crash, that's the market that's going to drop. Okay, so your condos, your single-family homes. We've seen that in my area, in the Willowdale area, in the Yonge and Finch area. It came down a bit. My bungalow went down from 1.9 million to 1.2 million, but I'm not selling. But I'm not selling, right? So I'm building now. Now, the real estate crash, okay, it's not gonna happen in the multifamily space. Okay, so that's why I'm in the multifamily space. It's because if there's any downturn in that real estate single family homes or the condos, people are gonna jump ship as tenants-wise, okay? Or people that was going to buy, they're gonna rent now, okay? So the multifamily space is very stable, okay? So what happened in 2008 and 2009 when we had that financial turmoil? My rents went up. I had a 10-plex at 44, 46, and 48 Chapel Street in Kitchener. My rents went up, I think it was probably 20% increase, okay? Oh, wow. So it went up, all right? So the multifamily space is a very stable market. When you ever have a crash in real estate, or let's say the stock market had a crash or anything like that, my rents went up. I'm not selling, right? So what does it do to my asset? If my rents go up, the price of the building is tied into the net operating income, the NOI. The value of the building just went up, right? So I'm not selling, but if I had to sell, my cap rates probably has gone up, right? Because my NOI has gone up. Now, if I drop it back down, the value has gone up. Okay, so really what does it mean? You have to take a look at the sector. You have to take a look at what area you're investing. So location,
Yeah.
okay. Now you're looking at the specific sector. Is it a condo? Is it is it single family home area? Is it townhouse? Is it going to be multifamily? So usually when you have a crash, I'm just going to generalize it,
Yep.
okay? It's probably going to be either your condo, okay, the condo area because they overbuilt, or your expensive area like my area, the 1.9 dropped to 1.2. I would be hurting if I had to sell,
Yeah.
right? So your expensive luxury houses, your builders would probably hurt, okay? Your condo buildings, okay, they probably hurt as well. The builders probably took it off the market or they had to build and they lost money,
Yeah.
okay? So if you're at the forefront of new builds, just be, be cognizant of where you're at. Okay, if it's very expensive, like Toronto market, you're probably looking at about, what is it, $1,200 a square foot, definitely over 1,000 square feet, $1,000 per square foot in the Toronto downtown market. Okay, for the condos. Would it come down? It could. All right, but that's why I always tell people get into the multifamily space because your multifamily that won't have this crash.
Yeah. Yeah, I think it's really important. I hear this question a lot on my YouTube channel as well. And like for me, it often comes down to affordability is kind of what I rest my head on. So like in my market in London, Ontario, we're often say you can buy for say $100,000 a unit. That's a pretty common metric. You can sometimes get a little bit lower, a little bit higher, but somewhere in there. And the average kind of rent for a 1-bedroom unit is about $100 a month. And so what I really like to $1,000 a month. And so what I kind of like to look at it is, minimum wage these days is $15 an hour, or it's about to be that very soon. So that's my minimum wage. And so if someone's making full-time minimum wage, they're probably doing 2,000 hours a year for their employment, or about $30,000 a year in income. And then the average Canadians often spending 30 to 40% of their income on shelter, which includes, say, utilities. So if I'm renting for $1,000 a month, utilities included, it means that someone on minimum wage can afford to spend, roughly $800 to $1,000 a month in rent. And so for me, I hang a lot of my hat on the affordability aspect when it comes to real estate. So like in London right now, I'm renting out what I call a McMansion house, so just like a big house built out in the suburbs. The owners are trying to sell it for $800,000. That feels a lot scarier to me because the affordability just isn't there, right? Someone that is looking to spend 30% of their take-home pay on servicing that property, they're looking at like close to a $3,000 a month holding cost between their mortgage payment, insurance, and taxes. And so in order to be able to afford that, they need to be making a 6-figure income. So I know that's often how I'm looking at it. So you've been investing, Casey, now since 2003. Have you ever really seen a dip in your rent prices where rent prices went down?
No.
So it seems like usually either rent prices go up or kind of plateau, stay even.
That's right. Plateau probably for maybe a year to 2 years. Right now, because, well, in the last 5 years, we were doing multifamily, it's a nice steady increase. The single family homes, they're pretty stagnant because the tenants will stay there for a while.
Yeah.
What actually hurts us as landlords is that they're there for 5-10 years. Now your price has gone up substantially, but your rents are low.
Yeah.
Okay. But question, the multifamily, the rents has relatively gone up. Has relatively gone up year after year.
And so how much time when you're looking at, say, investing in a new city or a new market, are you spending looking at like, I don't know, Stats Canada or the employment picture? Like what are your main focuses when you're trying to figure out a nice stable real estate market to invest in?
Good question. I'm looking for employment, I'm looking for jobs, I'm looking for companies coming in. So that's what I'm looking for. So the St. Catharines the job market was very strong. And the vacancy was actually very low. So you're looking at everything. You have to. Yeah. Okay. It's not just that one metric that's going to determine. And a lot of people would probably say price, right? So you can buy something at $40,000 somewhere else. Let's say in the States, but that's not the determining factor. It's never just $100,000 per unit, $40,000 or $30,000. Yeah. That's going to be you're going to run into problems because it could be $30,000 or $40,000 for the last 10 years, 20 years. Okay, we know right now, Matt, that we're at $100,000 per unit. Honestly, that's going up. That's on an upswing. Your rents are on an upswing as well, especially in Ontario. Okay, so your 1% rule is very, very comfortable. Okay, likewise with this, you're getting people that work that can afford this. All right, but yeah, it's when you talked about that $800,000 house that you're house hacking, whatever, in London, that's expensive. So again, you're looking at $800,000 in London. That's an expensive market.
It is.
Right? So in my market in Toronto, Yonge and Finch, a bungalow, detached bungalow, is selling for 1.2 to 1.4 million. Okay? It's a lot, it was only 1,300 square feet, but that's a market. When it went to 1.9, that gets very high. So yes, it had a downturn. Again, I'm not in that market, right? I'm not in that market where the crash could happen. I'm in the multifamily space where I'm in this space. So you have to look at it's a different type of investment. There's nothing wrong with it. Like, there's a lot of people that invest in that that market, but they probably bought it a while ago, 5 years, 10 years ago. So their average cost base is going to be a lot lower, right? Let's say if they have 10 houses. So they bought it 10 years.
Hey guys, sorry to interrupt the video, but just want to announce myself and Ben, we've extended the survey competition we're doing. So we're doing a round 2 for you guys. And in this, all you need to do is fill out that survey. You're going to get access to a ton of footage. You'll get the opportunity to win a chance to meet up with Ben one-on-one and a lot more. Ben and I have something to announce that we're really excited about.
We're getting married.
We're actually going to be starting a company, Cashflow Tribe. And so I'm really excited about this. It really combines a lot of our passions and a lot of our focus together. And so this is going to be a real estate business. It's going to be education oriented. And we need to know exactly what to make this business for you guys, for the audience. So here's the deal. We're going to put together a survey. We want to pick your brain and understand exactly what's holding you back from jumping in or leveling up as a real estate investor. And as part of this trade for filling out the survey, I'm going to give everyone that fills out the survey access to OREC 2019 footage. There's literally like 20 hours plus of amazing content from OREC 2019. But in addition, we're going to pick one lucky survey participant, and we're going to give away 2 free OREC tickets, as well as a one-on-one with both of us. So you'll get to sit down with us. Maybe Ben will even bring out the Lambo for you guys, and you can pick our brains on anything you want to talk about. And you should have a lot of questions for this guy that's already done 181 deals, over $21 million in non-bank financing, and that's just like the tip of the iceberg.
We need your help, guys, please. For us to really understand what's better for you, we need you to fill out the survey and tell us how we can help you. We're going to have off-market deals, tons of training and support. We're combining our two worlds to give you a lot of value. So please help us, and the trips and the excursions and fun things are a nice bonus, but truly help us understand what you need so we can help deliver it in a massive way. Let's do it together.
Absolutely. Link in the video description down below. It's just going to take a couple minutes. Jump over, do it. We'll give you free access to the course, and we look forward to hearing what's holding you guys back.
Let's go.
Let's do it.
Hey, one more thing. I'm also going to do a Lambo lunch one-on-one with whoever the winner is here today. We'll get a chance to sit down, drive the Lambo, have a bite, talk life, business, personal development, and I want to do that with you. So let's do it. Let's stay humble. Let's get it.
So you have to look at it's a different type of investment. There's nothing wrong with it. Like, there's a lot of people that invest in that that market, but they probably bought it a while ago, 5 years, 10 years ago. So their average cost base is going to be a lot lower, right? Let's say if they have 10 houses. So they bought it 10 years for each and every year for 10 years. Their average cost within their portfolio is going to be a lot lower. Okay, so they're looking at the entire picture of that portfolio. But my suggestion is that, again, get out of the space of the single-family homes in a way that you're just holding it, especially in the Toronto area. It can get a little bit expensive, and if you don't have the rents to cover, you can be up for a crash, right? If there is a crash going forward. I don't know. Nobody has a crystal ball. Exactly. Nobody has a crystal ball. But the thing is that I just know that if I'm holding a multifamily or holding even like a single family, a duplex or triplex, hold it for that 5, 10, whatever, 15, 20 years, you're going to refinance it, you're going to draw out your rent, and your tenants will be paying it off, right? But just be careful if you ever have to sell.
And so another question or comment I get often that's kind of paired with real estate crash is also like, what about interest rates? And so I'd love to hear your perspective just on interest rates. How much time do you guys spend studying interest rates and really getting comfortable with it? Is it a big deal to you? Like, how does that work? And even on your multifamily properties, are you guys locked in with interest rates or variable?
We are locked into a 2 or 3 year period in basically how we're going to refinance it going forward, right? So we, at the beginning, some of it was variable. Okay, so not on my first property. My first property was actually a 10-year fixed. Okay,
oh,
if you
wow.
believe it, yeah.
Okay.
Because I was scared. I was scared. So I did a 10-year fix. The variable was at 2 or 3%. It was back then it was low. I think it was like 3%. But I fixed that. I remember it's a 5.5% 10-year fixed with TD Bank. And what my comfort level back then was fix it. Okay, so I know my cost.
Yeah.
I'm going to hold that for 10 years or 20 years. I did hold it for over 10 years. So what I did was that I limited my downside risk, right? Although I'm paying more. So the more risk that you take on, the higher return, or the mitigating that risk factor, right? So I was comfortable with that, the 5.5%. I rented out for $24.55, and over those 10 years, I could have saved more, I could have earned more, okay? But I didn't, because I just want to fix that. Then in the next properties, the 4 and Barrie, it was all variable, okay? So it was all variable, I was comfortable with risk. And now we're going into multifamily, and now these are 2 or 3 year terms, okay? So 2 or 3 year terms, I'm gonna refinance it, because we're with some B lenders. Interest rates are a little bit higher. I stabilize that asset first. I get the rents up. Then I go back to my A lenders, which is your tier 1 banks.
Yeah.
Okay. So that's our strategy, and we're working with some executives from various banks.
And then so when your refinances are coming up, are you guys trying to stagger the refinances between your buildings, or is that a concern?
Not too much of a concern, because like all of our buildings that we buy, some of them was last 2 years, like 3 years or 1 year, or this last 2 months. So we can't really peg it in a way that all incomes due. It will be better, I think, for negotiating. Like if you go to the banks, the A lenders, and you say, hey, here's 5 buildings that we want to bring on to this bank.
Yeah.
It would be better, but it's not necessary. So we work with the bank. We work with, so if we have a portfolio, we say, hey, we have this one building, how's the next one? Can we take on the next one, and so on and so forth. But know that the banks want your money as well, or they want to lend, right? They want to be able to lend that mortgage out. So once you have good, favorable terms, you're a good client, they want your business.
Yeah.
Right? So one comes due, the next one is coming due next year or two, then you're talking to your account manager, right? We don't really go through a mortgage broker. We actually went directly with the bank.
And so are you guys concerned about interest rates? Like how much are you watching interest rates and Bank of Canada?
We do watch it a little. We're not in the capital markets where we're always constantly looking at those rates, or we look at it, but it's not a determining factor.
Okay. And so when you're doing your projections and stuff, are you using the exact interest rate that you're quoted, or do you guys put in a buffer to make sure if interest rates go up by 1% within 2 to 3 years when you go to refinance? What are your kind of approach on that?
To be honest, we actually didn't really do too much of that. We're actually more concerned with the rent. Okay, so we know that it's $1,000. It's going to go up to $1,100 or $1,200. That's what we're looking at.
Gotcha.
Yeah.
Awesome. Anything else you think the audience should keep in mind when they're thinking about, buying real estate, or family members are stressing them out by saying it's going to crash, or that interest rates are going to the moon?
You know what? Just put that aside. Everybody has their advice for you. Okay, you can take that in when you're analyzing, but you know what? We're in a market right now that's fairly stable. Okay, but don't stress on that. All right. Over the long term, the interest rates right now, if it rises, your rents are going to go up. Okay, so you know about that. You know about that steady Well, you know what the Ontario market right now. We're strictly in Ontario. We're not in any other market. But you do have to have that overall high-level picture of where the interest rates are going. Okay, it's not that we don't look at it. We do, right? But right now, it's not a determining factor. And people will tell you. People will chirp at you. People will say, "Hey, oh my goodness, like interest rates are going to go up. This is going to happen." Yes, it will, right? But over the long term, you'll do fine.
Yeah, I love it. I think it's really important that just you take everything with perspective, right? And if the fundamentals work in your investment deal, if you're not going to have like a cash call come immediately, it doesn't really matter if prices fluctuate a little bit on a per unit basis, because we're investing for the long, right? This is why it's a buy and hold strategy.
That's right. That's right.
Awesome. Thanks, Casey.
No problem.
We're here with Casey Wong again. We're in his Toronto office, and we're actually going to be talking about the marketing materials he puts together for his investors.
You have to have something for your investors.
Yeah.
They want to see it. They want to see what you put out there. It's a snapshot of the overall project. Location, where it is. It's not going to delve too much into the profit, the returns, but we'll give a quick little snapshot of it. We'll have the executive summary, the management team, the property development plan, project, the property location, market and economic overview, summary. You want to be able to explain as much as you can in this type of brochure.
And so the executive summary there, that's kind of like your elevator pitch. It's a summary of the overall project, a little bit about you guys. Thanks again to Casey. If you guys enjoyed this video, smash that like button. If you guys want more Casey Wong, let us know what Casey and I should discuss in future videos by commenting on this video. We want to hear your opinion. Casey's not super active with responding to comments, but he actually reads the vast majority of comments. So jump in that comment section, share your opinion, and until next time, remember, making money is a team sport. There's more than enough money in this world for us to all make it, but if you're not saving it, I mean, like, what's the point? Thanks, guys.